Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So we've had a lot of connectivity problems. So the EIA show, this show, hopefully we'll get them out by Thursday, just given uploads. I don't know if is anyone else having these issues? I know that a lot of people are on Zoom or working from home, but I mean, if we really want to make this a long-term switch or at least, start to see some adjustments, we're going to have to fix these connectivity problems. Maybe this is a good investment, but who knows? But anyway, so we obviously had a very big OPEC meeting. Today we're just going to go through in this show specifically. So this kind of connects back to the EIA Part 3, Segment 3. But this is just going to look at purely what happened with the OPEC meeting. What did Saudi Arabia do? What does that mean going forward? And try to kind of look at this in terms of where do we go next on price. So just kind of jumping right into it. This is a running tally that we've been keeping. So the January production targets, you get an idea of kind of where we sit, where we are right now. So right now we were supposed to have a total, and this is just for the OPEC, not including the exempt countries, but about 22.119. So realistically, we're supposed to see the inherent, just the amount is supposed to be from Saudi Arabia in January, is supposed to be about 9.2 million barrels. I should say 9.119. Instead, they have now opted. So that's January. January's in, it's fine. There was an increase of 500,000 barrels. Now, the disagreement happened was now Russia and Kazakhstan wanted to increase another 500,000 barrels in February. Others did not want to do that. So there was an agreement made. The agreement made was Russia and Kazakhstan can increase production 75,000 barrels, 65 for Russia, 10 for Kazakhstan, and everyone else was going to roll over from January into February. Now, Saudi took it upon themselves to do a voluntary 1 million barrel a day cut. So now instead of it being at 9.119, it's going to be at 8.119. So that carries over into March. So February and March, we'll see the same 75,000 increase in Feb, another 75,000 barrel a day increase in March, but the voluntary cut will essentially maintain between Feb and March. So instead of the January production numbers of 22,119, it goes to February 21,119, and then March the same. While the Russia goes from 9,119 to 9,184 to 9,249. So we're going to get that increase over that same period of time, which is kind of offsetting. It was a way to agree. So instead of getting a 500,000 barrel a day increase in Feb, and 500,000 barrel a day increase in March, you get 75 and 75, but then obviously the 1 million barrel a day voluntary cut from Saudi. So this is kind of an interesting thing. And now Nigeria is saying that they'll be caught up with their expected cuts that they were supposed to do. And the makeup cuts will come through, which we'll talk about in a minute. And then they'll be kind of true up with where they are. Now, Iraq, on the other side, continues to be well away from where they should be. If we think about the January price, the January target of 3.857, that's where we continue to see some of these issues. And then now the UAE also has seen some increases, which, comes back to how much, production is one thing, exports are another. And now it's a matter of how much production is there versus how much exports are actually happening to try to offset. And that's where, Kuwait has said that they had 3 new oil finds. The UAE has announced their own. The North Sea has seen some extensions that were just announced, that there's some new oil. So again, these are things to watch because even though some of these are offshore, some of them could be, extend onshore, there's a lot of infrastructure currently in place. So it's not the same type of turnaround to bring these new finds on. Again, very early. Some of this was kind of well known. It's just a matter of when does it actually turn into something different. But this gives you an idea of where the new OPEC totals are. And then this gives you an idea of where they were supposed to be. So when we look at where things were supposed to be, OPEC cut was in Jan was 7.2. February cut was supposed to be 7. Well, then this is just because this is looking at Saudi Arabia without the voluntary cut. So this is assuming the rollover of 9,119. So this is why the numbers can get confusing in terms of, well, why are they talking about this cut that doesn't include? But, well, this is it. Jan is 7.2, Feb cut is 7,125, and March is 705. And that's the increases that were coming from both Russia and Kazakhstan in terms of as they could increase over that time period. Now, the numbers we talked about before are factoring in the cuts from Saudi Arabia, which is actually that an additional 1 million barrels. Now, Russia asked them not to do it. They said, please don't do this. This is, and the reason why, if you consider kind of where we sit, this is going to allow and enable others to come back to market. That's, and by others, I mean more around the U.S. Now, I'm not saying that we're going from 11 million barrels a day to 12. That is not happening. It's just we're going to see less declines than expected because this is going to bring more back, because this is going to open up hedging opportunities, and they're going to be able to lock in prices that are a bit more agreeable than 42. If they can lock in 50, 51, 52, that is going to provide upside or at least a floor to increase production. And it's just by increasing production, they're just offsetting some of their decline curve. There just isn't a market for 13 million barrels a day of U.S. crude. It doesn't exist. There is a market for 9 to 10 million barrels a day of U.S. oil, and right now we're at about 11. So what does this do? This opens up the opportunity of bringing back all of the frac spreads that went on holiday, as we talked about, going from that 159 down to that 134. But we were expecting to take a little bit additional time to get back to, let's call it 160. We thought it would take kind of the month of January. Now there's going to be a snapback and new crews are going to come back. And this, like we have spoken to EMPs that talked about how they were going to wait a quarter before they brought back a new crew. And this is just going to accelerate some of that, especially because this extends through February and March, which again provides them an opportunity to bring back some of these spreads. And now if Saudi Arabia says, oh, by the way, we were kidding, we didn't mean to do this. Well, did the EMP already hedge? Did they already position themselves where a down move really doesn't change too many of their plans? It may not bring back all of a new crew, but it's easily going to support the activity that happened up to this point. And now you might think, well, they not only did they cut, but Saudi Arabia also increased OSPs, or official selling prices, for February. Now they increased all of them into Asia, all of them into the U.S., and then cut into parts of the Mediterranean, parts of Europe, all of Europe, and parts of the Mediterranean. So now the next comment is, okay, well, you're cutting production and you're increasing OSPs. Well, what should historically OSPs be at this time? Now, when we look at OSPs, Asia is still below average. Mediterranean and U.S., so I should say Asia and U.S. are kind of at the average that they have been in the last, let's call it 10 to 15 years. And now Asia, Mediterranean and Europe are actually higher than the average over the last few years. Even though it's a net cut and there's a net rise, you have to look at, well, where should they be at this point in time? Because typically, you have heating demand, you have some demand that normally comes into the market, so you have prices that move in accordance, given if it's shoulder season, peak season, and kind of where things move around. So that's why when we look at, this is looking at the Middle East, super light crude Saudi to Asia OSP spread versus average. So when we look at the average, you can see the average is normally at about, let's say at about $4.50. Instead, we're sitting here and we're at $1.85. So again, there's that separation where, okay, yes, and you can see that it's at the lower end going back to 2007. And the reason why we went back to 2007 is that's factoring in 16 and 16, 15, 16, 17, that's factoring in 08, 09. That was just looking at, where should we be? And you can see it's still on the lower end. Now, obviously, this is free on board, so there's shipping, there's insurance, there's other things that come into play, but you can see that we're starting at this lower level. Even though it's an increase, it's still kind of within the normal spread of where it could be at this point in time, given we have seen an increase in Oman, Dubai, and then just in terms of crude in general on a pricing level. But this action is also going to hurt refiners because refiners are buyers of crude, and their feedstock is now getting more expensive. So that means that they're going to see additional pressure on their margins because they're going to have to push through price increases. There's already a demand problem, and you already have additional crude, additional product that you have to clear. So this is why this is going to create that demand trap where we don't really have the demand, but you're not really helping us. So if anything, I'm going to try to reduce my runs or maintain the lowest runs possible just to lose the least amount of money, which again becomes this kind of back and forth issue. Now, shifting and looking at it a little bit differently, let's look at light crude Saudi to Asia. Okay, well, you can see that we're right at the average price. Again, there's really not much happening where, yes, you see the big, there's an increase, but it's still within that margin of comfort. Now, Urals were trading at significant lows. There had been no purchases done in the month of December for Urals. So this is just going to push Asia, and specifically India and China, to go and purchase Urals as they've had issues in terms of pricing into Europe. This can now redirect some of those barrels into the Asian markets. So that's why when we look at the crude loading schedule, you can see that Norway, as we talked about in segment 3 of the EIA, we have the North Sea that's producing about 2.2 million barrels a day, highest since May of 17. We have Norway, which is at 1.72. Again, you can see the trend higher, offsetting those declines. Nigeria's continuing to walk that back as they're struggling to sell some of their cargoes. Chevron just cut prices again. Angola has continued to cut prices. They've now cut them twice over the last week. These are, again, like when we think about what is Saudi doing, is Saudi looking at physical prices and saying, look, I'd rather keep it in the ground than try to pump it, put it onto a boat, and then try to compete with some of these other prices and have to, have a knife fight on what discount or premium to OSPs am I going to cross? Or will I leave it in the ground, offset some of this, and try to kind of adjust where things are overall? Or is this something where they're just looking at it where demand is going to be so bad that they're okay missing this? So again, coming back to the physical pricing. Now, loadings of 13 main North Sea crudes, again, scheduled to rise to that 2.11 million in February, the highest in more than 3 years. And that's thanks again to Norway, as we have more production coming on within Norway itself, especially more loadings. Libya, the total OPEC production increased in December by about 196,000 barrels. Again, that's Libya. Libya is coming back, as you can see in December. They were able to produce or export about 1.1. They're going to be at about 1.12. And we think 1.12 is very comfortable. They had some issues with some sit-ins on missed salaries, but that has been cleared, and now they're back to loading. Again, this is going to be Libya. We're expecting them to maintain over 1 million barrels, which will put more pressure into Europe, which is why Russia is looking to sell crude elsewhere. So by Saudi increasing OSPs into China, and the issues that Russia's seeing into Europe, that opens up that market for Russia in general. Again, this kind of push, this give and take, especially as West African crude has struggled to go into Europe, even though they've seen price cuts. Libya is now in there, and there's more sitting off the coast of Gibraltar, and it's just going to be a matter of kind of moving this around. Again, the physical market still remains well supplied, even though we're talking about what is going to happen in February and March. And are we going to see lockdowns? Because obviously they've been extended to January 31st for a lot of different places. Will we see that continue into February? And if it doesn't, do we see people, doing less? Especially because February is when we start, is the middle and on, when we see additional run cuts due to maintenance season, and that starts to increase. Plus, we have Lunar New Year. Lunar New Year is, depending on, whether it's early, the end of January into February, or kind of where it sits, that is also a big down period. So that's why it's going to be interesting to see how does Lunar New Year impact that. Was Saudi looking at this and saying, look, they've already purchased for deliveries in January, February into early March. Anything I sell right now isn't going to get run until 2Q. So let's pull back, take a wait and see approach, and then we can add barrels as we see fit. Again, these are things that have to be, again, trying to play devil's advocate. We're trying to look at, okay, well, the prisoner's dilemma, who's doing what, why are they doing it? And but the end result is 1 million barrels of production is not going to come into the market. And again, they have a lot of storage. They could sell from storage if they wanted to, if they want to adjust what they've done. That's why we have to look at not only production, but also the export side. Now, when we look at what's gone east, and this is interesting because when we look in December, you can see that there was a big push for Saudi crude going into the new year, where buyers were at 8-month highs. So you can see who was buying. You had China, the largest buyer. China and Japan were the two biggest buyers of crude going from Saudi going into January. So now January you have the additional increase in production, but maybe they're looking at this and saying, look, we don't want to go past that, and maybe we're hearing that there's not the same amount. These are things that we have to look at. So Saudi boosted crude shipments last month to the highest level since April, due to an increase in exports into East Asia, notably China and Japan. Again, this is the Saudi Arabian increases was the highest since April, the April month, and then obviously May, June, everything went down. So that you can kind of see where we're snapping back, where going into December, we're actually year over year, exports were higher than 2019 in terms of how we closed out 2020. So this is, again, kind of looking at that export market where they were at that 8-month high. But when we look abroad, so shipments rise to the highest since May ahead of relaxation of output restraints. Saudi, Iraq, Kuwait, UAE. You can see Saudi had that bump, but then we also had Iraq with a bump. This is what we're looking at as we kind of see what those shifts are. Obviously, we still have cuts as we go into the previous in 2019, but that's why it's interesting when we look at the aggregate versus what did Saudi export, and they exported an amount into China, or I should say into Asia, that we haven't seen since April, and that still outpaced last year. So then when we go to key Gulf OPEC oil exports to China, this is what we're talking about when we have a big bump into China, with Iraq and Saudi being that biggest piece. Now, the Iraqi sales are actually increasing with some of the new Basra crude, because they split up some of their grades, have increased, which is obviously going, China was one of the first buyers of it. This is what we're looking at when we start to say, okay, well, Saudi's going to pull back, but Iraq is there, UAE is going to be there. Kuwait should be fairly stable, but we're expecting to see an increase from Iraq and the UAE as we head into not only just January, but in February into March. Now, when we look at, this is from the EIA show, segment 2. This is just looking at the vehicle driving miles that have just come down over time. And you can see that we obviously had the impact from the holiday season, but the holiday drop, we had a fairly sizable bounce from that March lows, in March into April lows, but we were also going from winter into spring, and then we had spring into driving season. we don't really have that situation right now where we still have another 2 months worth of winter. Typically the flu season, depending on how cold it gets in March and April, can extend that far. And if we think about how COVID spreads, how the flu spreads, there's a lot of similarities, which just means that there's going to be a continuation, and you're not going to see this big bounce. You'll see a bounce off the bottom, not saying you won't. That's obvious. Like, we'll see a bounce. People are going to go back after the holidays. It's just the slope won't be what it was, which is just going to reduce total refined product demand and keep it capped, which will also cap oil demand. And then when we think about purchasing from China, just to kind of pause for a minute and recap what we've said. So China refiners skipped purchases of Urals crude again in December. Shipments from Europe might resume this month after UNIPEC bought some Russian grades, but you're starting to see, again, Ural prices have been a problem, but now with Saudi coming down, this opens up a new avenue. And that China last bought Urals for October loading, which again is looking at, and not to say this is loading. They could have bought spot cargoes. Their crude changes hands multiple times in its voyage. So this is just for crude for October loading. The last time they bought it outright was Urals in October. But there's a really cold winter. So the cold winter is creating these shortfalls in China as well as other areas, which is why we're seeing colder than typical winters, which is promoting factories to buy portable generators, which they run on diesel. And they also have opportunities to potentially run on natural gas and propane. These are things to also look at. Also, on the other side, looking at Brazil, so oil exports increased in December as producers in Petrobras offset some of their declines. Making up for the lower volumes. Exports were up 5.6% month over month, down 33% year over year. Shipments from the terminal, again, were from Petrobras were down 36% month over month. But again, those were offset when we're looking at kind of where things are. And we're going to start to see those increases as we head into throughout January. So now when we look at Iraq and what's happened, so when we look at what should have happened, so in December, total exports were at 3.257. So 3.257 million a day, which was above November. And the nationwide monthly exports increased by more than 5% in December. So this is just an aggregate to a total of 3.3 million barrels a day, ending the year that saw annual oil exports and revenue drop to obviously multi-year lows. Now, technically, Iraq's oil exports, what they should be was something obviously much lower, as you can see based on the tracking data and then based on what should have been talked about. But the average exports for 2020 was about 3 million barrels a day, which is 15% drop due to the agreements. Iraq earned about $42 billion in cash. Multi-decade low. So this, lowest in more than a decade. Again, these are the issues that they're seeing, because if they can't get price, they're going to get volume. So now that they can start to get price, are they going to reduce volume? Or are they just going to try to maintain the volume they're at to try to capture the higher price and help out their balance sheet, given how they had to devalue their currency and they just signed a deal with China to pull forward $2 billion or so of USD. These are things that they're looking at, and it's unlikely to see them cut now that they have not only the increase of 500,000 barrels in January, which helps legitimize their cheating that they've had. It's just we don't expect them to make up for not cutting when they were supposed to and really going above their quota, as Russia has been pumping above their quota since the beginning, yet they were allotted a 75,000 barrel a day increase. So maybe that's like, look, if you're not going to cut, we'll just allow you to pump at those levels. But again, they didn't cut, so they should be having makeup cuts, and that just won't happen. Again, which talks about the legitimacy of the agreement. What does this mean going forward as the agreement starts to unravel and as others start to benefit at the essentially for at the expense of someone else. So when we look at exports are increasing ahead of the plan, exports picked up, and when we look at the unprecedented cuts, you can see that the production's kind of flatlined, but even as production is flatlined, exports have increased from Iraq, which is only going to remain that case especially as more flows into China. But the other side is we have U.S. LNG exports are just crushing it. Now, we're building 2 new products. One is going to be natural gas liquids. The other is going to be LNG. And this is just looking at the big ramp that we've seen as prices continue to top almost $20 in Asia. As there's that shortfall, as there's that freeze off that continues to colder than expected winter. But there's going to be more volume now as you have more LNG out there. LNG and LPG have the ability to essentially switch and replace diesel, fuel oil, diesel, distillate in general. So that swap just means that there's going to be more pressure. So there's just going to be more pressure where you're going to see less diesel consumption, more LNG, LPG consumption, which means that it has to swap. And so that swap is going to be, essentially cap, or at least put a lid on some of the additional flow for oil and for diesel. And as middle distillates can't move, that means refiners won't run as much as they're going to have more in storage. But that means LNG, LPG, or NGLs and liquids in general will see a bit more of a bid, and that's why we think there's going to be, a bigger adoption, more growth in the LNG and LPG markets. And that's why when we look at LNG imports now, as obviously they slowed down in 2020, as you had cancellations, as you had issues going into, you already had a warm winter, in January and February, but you also had obviously COVID impacting that. But even with all of that, you still have a pretty stable 2020 versus 2019, given all of the issues that we had. And now we're expecting to see an increase in adoption, more facilities coming online, and more natural gas being adopted as we continue to see an adjustment to and the environmental side. Now, China speaks a good game. They want to say all these great things, but we all know that there's always you have to look at why would they do this. And if they want to attract PhDs and people who have PhDs in artificial intelligence, machine learning, they need to provide a strong, or at least in a desirable place to live. And these people can work anywhere. They have PhDs from Stanford and MIT, what have you. So in order to attract them, you need to give them a place they want to live that it will be comparable to other places. So that's why even if they may, China speaks a good game, and we all know they're not going to hit the targets, whether they're 2040, 2050, 2060, whatever number they put on it, they still have an incentive because there is an economic impact to cancer, to high medical costs, to asthma, to respiratory problems. And we all know that that's connected to particulates in the air. What's the quickest way to take that out of the air? Replace coal with natural gas, replace high sulfur fuel oil with natural gas, diesel with natural gas. Again, this is that conversion, which is why we're going to see a bigger adoption of LNG and LPG. But again, that's going to replace diesel and other types of middle disti and even parts of the light distillate pool, and it's going to replace it with liquids. So again, that's why even though we're going to see oil demand growth over the longer term, is it going to be driven by black oil or is it going to be driven by liquids? And that's where we differ with some pieces of the market, which we've written about, talked about, and will continue to highlight as we go forward with LPG and LNG seeing a bigger adoption overall. So hopefully this was helpful. If you have any other questions, please, leave us comments, questions. Please watch this or link this with the EIA Part 3 show, because there's a lot of similarities in commentary that kind of goes back and forth. So thanks again for watching. Stay tuned for the Econ show. A lot of stuff to cover. Again, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.